Stablecoin rules turn issuers into pseudo-banks, squeezing small players. Stablecoin issuers in the United States now have a compliance manual that reads like a bank charter. Three federal agencies have published the rules that put the Genius Act into force, and together they convert issuance from a software job into a supervised financial activity. CryptoSlate laid out the framework on June 21, 2026, drawing on rulemaking that has trickled out since the law passed. The headline effect is not the legal clarity that issuers asked for, it is the price tag attached to that clarity, and who can afford it. Three agencies, one supervisory regime. The rules come from three places, each adding a layer. Treasury, through FinCEN and OFAC, requires anti-money laundering and sanctions compliance programs. Customer screening, transaction monitoring, sanctions checks against wallets and counterparties, and suspicious activity reporting. The Office of the Comptroller of the Currency wants weekly confidential reports and quarterly financial reports from every issuer. The FDIC applies Bank Secrecy Act obligations to the issuers it supervises. Stack those together, and the obligations look like a mid-sized bank's: identity checks at onboarding, live transaction surveillance, reserve disclosures, annual examinations, and for issuers with more than $50 billion outstanding, audited annual financial statements. The timeline has been incremental. The Genius Act was signed in July 2025. Treasury opened rulemaking late that year. A joint Treasury and FinCEN proposal on AML rules landed in April 2026. The FDIC's parallel rule was published on May 22, 2026, and the OCC released draft reporting forms this month. The full framework takes effect in 2027. One provision stands apart from the paperwork: issuers cannot pay interest or yield on stablecoins. That single line reshapes the economics of holding a regulated dollar token. Bank-grade compliance becomes the price of entry. The article's core argument is about cost, not legality. A compliant issuer needs legal staff, transaction monitoring vendors, and reporting systems that feed regulators on a weekly cadence. A large issuer already runs most of that machinery. A startup mint does not and cannot spread the expense across a small float. That asymmetry is the point of friction. The framework formalizes what large issuers already do, in the article's reading, while making the same posture prohibitively expensive for newcomers. State-chartered non-banks that cross $10 billion outstanding are pushed toward federal licensing, which raises the bar again. The expected outcome is consolidation. Fewer issuers, each larger and better capitalized. The numbers attached to that forecast are concrete. The stablecoin market sits near $320 billion. The FDIC projects that 5 to 30 institutions could win approval to issue through subsidiaries in the early phase. In a market that size, a ceiling measured in dozens is a deliberate narrowing. The incumbents are already adjusting. Tether is steering toward USAT, a US-compliant product, and Circle is leaning further into its regulated posture. Both moves read as preparation for a field with fewer competitors and a higher floor. The no-yield rule reshapes stablecoin spending. For anyone who funds a card or a wallet with dollar-pegged tokens, the ban on yield is the most direct consequence. A regulated US stablecoin becomes a pure settlement asset. It holds its peg and it moves, but it pays nothing while it sits. The interest earned on the reserves backing it stays with the issuer, not the holder. That pushes the reward back to the spending layer. If the float earns zero, the value a user can capture comes from cashback rewards or staking yield generated outside the stablecoin itself, not from the balance. It also sharpens a distinction crypto card users already navigate in the United States. A custodial, regulated stablecoin sacrifices yield for legal certainty, while self-custodial or DeFi-routed dollars can still earn but carry counterparty and smart contract exposure that the new framework is built to discipline. For card issuers, consolidation has a quieter effect. Fewer approved stablecoins means fewer settlement options, and the ones that survive will be the large, audited tokens that pass bank-style examinations. That is a stability gain and a choice loss at the same time. Consolidation by 2027, the through line is that legal clarity arrived with a supervisory regime bolted to it. Issuers wanted rules they could build against. They got rules that also decide who gets to build. The compliance burden does not ban small entrants outright. It prices most of them out. And the FDIC's own projection of 5 to 30 early issuers signals that the agencies expect a concentrated market rather than an open one. The framework is not fully live yet. The reporting forms are still in draft. Examinations begin under the 2027 effective date, and the count of approved issuers is a projection, not a final list. What is settled is the direction. A $320 billion market is being routed toward a small number of large, well-capitalized issuers, and the independent mint that defined the early stablecoin era now faces a checklist written for banks.